Good afternoon, everyone. We'll go ahead and get started. So thank you for joining today's investor update for Hela Apparel Holdings, covering our recently published earnings release for the fourth quarter. So my name is Adam Collins, General Manager of Corporate Affairs and Investor Relations for Hela. I'm also joined by our Group CEO, Jalanka Jinadasa, our Group CFO, Ruan Fernando, our General Manager of Treasury, Nabuja Pramaratna, and my colleague from our corporate team, Shannon Gomez. So to outline the agenda for today's call, we will start with a presentation of around 15 minutes that covers our Q4 results before we move on to a Q&A session. So the structure to the presentation, which I'm showing here, is a little bit different from previous quarters, and that really reflects the new structure of the business following the acquisition of Focus Brands in January 2024 as the foundation of our new brand licensing division. So as such, we'll start with a few slides providing an overview of the group's consolidated performance for the quarter before moving on to discuss the two business divisions separately, starting with the brand licensing division and moving on to the existing business, which we're now referring to as the private label manufacturing division. We will then sum up with a few slides in the group outlook. And as always, we have included a few slides on our social capital initiatives that we won't be presenting, but we will be sending the deck out after the call, so we would encourage you all to refer to them at that point. In addition, we will be making the recording of this call available on our YouTube page, as usual, for any colleagues that weren't able to join the live session today. And as I mentioned, following the presentation, we will be moving on to a Q&A for the remainder of the session. And questions can be shared through the Q&A box on your Zoom interface. And we would very much encourage you to send those in as we go through the call, and then we'll run through them at the end of the presentation. And finally, before I jump into the presentation, a quick disclaimer on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place sole reliance on them. We also do not undertake any obligation to update these statements to reflect future events or circumstances that may arise. And with that, I will move on to the body of the presentation. So to start with the group overview. So this slide gives a snapshot of the Q4 results. And now, more than previous quarters, there's a lot of factors at work behind these results. And so before I jump into them, I'd just highlight two in particular. So the first is the consolidation of Focus Brands. So the acquisition was completed towards the end of January. So this is really showing 2 months, so February and March, worth of Focus Brands performance being fully consolidated into the group financials. So that is both contributing to a step change in both revenue and the cost base that you're seeing on the P&L as well. In addition, the second major factor for the quarter is that there were some major one-offs, both positives and negatives. So most notably, there was a one-off valuation gain as a result of the acquisition, which has been a significant boost to profitability. But as we go through the presentation, we'll try to elaborate a little bit more on the underlying performance of both divisions, extracting or abstracting from those few one-offs in particular. But taking that all together, this is showing the overall group performance. So we did see a notable jump in revenue during the quarter of 4.8% year on year to almost 22 billion rupees. And that was a 50% or actually over 50% increase quarter on quarter, so compared to the third quarter. This was also just by a reasonably significant appreciation of the Sri Lankan rupee against the dollar. So on a year-on-year basis, that appreciation was about 12%. So if we look at it in US dollar terms, which is our reporting currency, the year-on-year improvement in revenue was about 20%. And very notably, this was the first year-on-year increase in revenue in about 4 quarters. And I should say that it also doesn't just reflect the consolidation of Focus Brands. There was also greater stability in the revenue of the existing business. So on a quarter-on-quarter basis, the revenue of the private label manufacturing division increased by over 10%, which is the first material increase since about the second quarter of FY 22-23 financial year. So really showing some significant improvement there as well. And so as I mentioned, the profitability was boosted in particular by the consolidation of Focus Brands, which as well as the one-off gain coming off the acquisition. So really, that's why you're seeing that improvement in gross margin. And then because of the one-off gain, you're seeing a much larger improvement also in the EBIT. And that's flowing down to an overall reported profit after tax of 4.5 billion rupees as well. And due to that performance, we've also seen a significant improvement in some of our balance sheet indicators. So net debt to equity, so the net debt to equity ratio in particular was 2.7 at the close of the fourth quarter. That is slightly up on a year-on-year basis, but is significantly down on a quarter-on-quarter basis. So that is an improvement we've shown there. To move on to the next slide, I won't present this in detail. This really summarizes, the text of this summarizes the key messages I was drawing out on the previous slide, but I will draw your attention to the chart on the right-hand side, which shows group revenue for the quarter split by division. So as you can see, the lighter blue bar, which is the brand licensing division, contributed about 26% or a quarter of revenue during the quarter. So it was a significant boost as well. But as I mentioned, there was also an increase in the revenue for the private label manufacturing division as well. Moving on to first talk about the brand licensing division. So given the new two-division structure of the business, we're seeking to explain this in a slightly different way to previous quarters. So what we are showing at the top of this slide is the revenue for the brand licensing division and the EBITDA, specifically adjusted EBITDA. So we've adjusted it for major one-offs in this case. So from a revenue standpoint, the brand licensing division was at about 5.7 billion rupees, and that reflects, as I mentioned, those 2 months of performance during the quarter, so February and March. And from an adjusted EBITDA standpoint, we saw it was about 370 million, which was a 6.4% EBITDA margin. And that's really adjusted for that one-off gain, valuation gain that I mentioned at the start on the acquisition, and then a few one-off transaction and restructuring costs that were in there as well. So as I say, a reasonably okay EBITDA margin underlying that. And in addition, the main highlight of the quarter was that we established a new management team following the acquisition. So they have been busy working on an ambitious restructuring strategy to really drive profitable growth for this division of the business over the coming quarters. So that focuses on 4 key pillars, which I mentioned here, which is a reinvigorated brand and marketing strategy. So really driving that sales side, the restructured cost base and making sure that's at an optimal level, as well as looking at kind of new opportunities to grow the business. So that's new license and distribution opportunities, which I'll talk a little bit on the next slide. And also looking at how we can ensure we are maximizing the synergies with the manufacturing division and really how we build that up and use that to its maximum advantage. So on that basis, a few very major highlights that we'd like to draw your attention to for this quarter. So as some of you will have seen, we announced a strategic partnership with Tesco to sell Peterworth and Fenchurch products in Tesco. So Peterworth and Fenchurch are 2 brands which the intellectual property of which is owned by Focus Brands and it was acquired as part of the acquisition. And so they have never been sold in Tesco before. So this was really a partnership that was fostered via the relationship of the existing business with Tesco. And so those products will appear in Tesco stores later in the year and in about 100 UK stores, 100 of their larger UK stores later this year. So we see this very much as one of the first major examples of the potential synergies between the brand licensing and manufacturing divisions, really showing the potential there as well, because there is also a lot of scope for the manufacturing division to do the manufacturing for these brands as well that are being sold in Tesco. So we're really providing that across the value chain solution. The second major factor we'd like to update you all on today is that we have signed an exclusive license for Reebok outerwear products in the UK and Europe. So this is a brand new license for Focus Brands, and many of you will be familiar with Reebok as one of the largest and most prominent sports brands in the world. So essentially what this means is now Focus Brands will have the right to design, sell, source, and distribute Reebok outerwear products, which we're talking about jackets, soft shells, bonded fleeces, all of those kind of outerwear products in the UK and European market. So that's yeah, and on an exclusive basis. So that's a significant new addition to the business over what we acquired it with, and we expect that to be one of the factors that will be driving the business growth over the coming quarters as well. And finally, on the cost side, the decision was taken to close one of the UK distribution centres and offices, which is specifically the one located in St Albans, just outside of London. So the business had 2 UK distribution centres, and so essentially the view, after assessing the situation post-acquisition, it was saw that both sites were not being used to their maximum capabilities, and then it made there was a cost benefit from centralizing everything in the larger and more modern location. So that location will be closed from July, and we're also expecting some cost benefit from that side. So that's one of the major initiatives we've taken in order to also drive further margin improvement for that business going forward. So that's the kind of main updates for the brand licensing division. I'll now move on to discussing the private label manufacturing division, which we're abbreviating to PLMD here as well. So on this division, I'm showing the same, the table at the top is showing the same snapshot of the results for this division. So again, it's revenue and then adjusted EBITDA for this division. So adjusted EBITDA in particular is adjusted for a number of one-offs during the quarter. So from a revenue standpoint, we saw just under a 12% quarter-on-quarter increase. And I think in US dollar terms, it would be about a 15% increase. And that is, as I mentioned earlier, the first material quarter-on-quarter increase in sales since Q2 of FY23. So that's a significantly positive sign that we're seeing greater stability in demand for this part of the business. From an adjusted EBITDA margin perspective, there was a slight decline in margin, so from 1.4% in the preceding quarter to 1.8%. And really, so 2 of the major factors behind that during the quarter were the appreciation of the Sri Lankan rupee, and to some extent also the Kenyan shilling versus the US dollars, which have increased the local currency denominated operational costs that we have in the manufacturing business. And in addition to that, the significant disruption to shipping via the Red Sea has also increased the cost base due to some of the operational disruptions that has created, and also kind of overall increasing costs and intensified margin pressures coming through from customers as to who takes that increased cost into their P&L as well. So those are kind of the two factors that we see driving that, and that's why you see that slight deterioration in the adjusted EBITDA margin. So giving you a bit more of a snapshot of how that looks at a country level and from a capacity utilization standpoint. So due to that bump in revenue, we did see a reasonable 18% or just under 20% increase in our output, which we measure in standard hours. So the chart on the right-hand side is showing the quarterly standard hour output for the group on the left-hand side, and then at each country level on the right. So what you can see is that bump in Q4 was primarily driven by a bump in Sri Lanka and Kenya. And that's helped to support an increase in our capacity utilization rates up to over 90% compared to about 80% in Q3. So that is also an improvement. And as you will see, there was slight declines in Egypt and Ethiopia. And that partly reflects their larger exposure to the disruption in the Red Sea, just by the nature of shipping to those locations for imports. So the operational disruptions there, and customers choosing also partially to risk mitigate in terms of production in those locations. Moving on to a couple of additional highlights. We'd like to flag for the quarter for the manufacturing division. So the first really is, now that the acquisition of Focus Brands is completed, as I mentioned earlier, there's a real focus on how we really maximize the synergies between the 2 divisions. So obviously, the kind of key benefit for the manufacturing division is the extent of which there may be additional sourcing or additional manufacturing orders coming from Focus Brands. So we're collaborating with Focus Brands team closely on how we ramp up the collaboration between the 2 divisions on that front. But currently, we're expecting the sales from Focus Brands to be private label manufacturing division to increase by about 4 times this year. So we will see a significant increase coming in there as a result of the acquisition. In addition, we're continuing to focus on building new customer relationships. So one to announce for this quarter is Tommy John, which is a fast-growing US underwear brand. And so the first production of men's underwear for that brand is currently underway in Kenya for shipment during the course of this month. And we're expecting to see significant growth from this customer as well. They're very positive on our footprint and the manufacturing capabilities as well. So that's another positive development for the quarter and adds to the number of new customers we've added over the past two to 3 quarters as well. And finally, a final section just to sum up the outlook for the group. So I'll take first a brief kind of comments on the operating environment before I touch on both divisions separately. So overall, the operating environment for the sector has remained reasonably benign despite all the challenges. So consumer demand conditions in our key markets in the US and Europe are remaining reasonably resilient, though there are still some significant downside risks. You know, there's the expectations of interest rate cuts, you know, get pushed back and pulled forward. So it's a little bit clear when some of those pressures will ease, but certainly there's stability that we're seeing certainly in demand. Kind of key wildcards on the horizon are there's a couple of major elections, both in the UK and the US over the coming months, and that will have a large impact on the future of economic policy in those 2 markets. And then, of course, as I mentioned, the shipping disruption in the Red Sea, which looks set to continue for an extended period and is causing a number of challenges for the global logistics industry that even we're seeing currently as well. So in that context, the outlook for the 2 divisions, starting with the brand licensing division, the first one to flag is that, so for the immediately coming quarter, so Q1 of the FY25 financial year for the brand licensing division, Q1 is historically a softer quarter for Focus Brands due to the seasonal nature of that business. It's more skewed towards sportswear, so it's a little bit stronger in the summer. So we're expecting to see a little bit of a softer demand picture in Q1, but it should pick up strongly thereafter. And we're expecting a full year profitable result from that division. I should also mention that some of the decisions that have been taken are in order to mitigate that seasonality. So for example, the Reebok license is also going to partly mitigate some of the winter softness that we see in that business by smoothing out the brand portfolio. So overall, a positive outlook for the brand licensing division, and I would say that we see significant upside from the existing business in terms of some of the initiatives that we're taking, you know, the new licenses that we've added and some of the restructuring initiatives that we've undertaken as well. There's a lot of positivity on that side of the business as well. And then moving on to the private label manufacturing division. So the current order book does suggest a further pickup in revenue in the coming quarters, and I'll touch on that on a subsequent slide as well. But even in that context, given the challenges that we're seeing in a slightly uncertain environment, particularly with the disruption in the Red Sea, we are continuing to consider further measures that are as needed to ensure that we are driving profitable growth for that side of the business. So we haven't completely shelved all of that. We do see that there's more work to do on that side to ensure that that is independently and sustainably profitable. So to touch a little bit more on the demand picture, and this is specifically for the manufacturing division, and this is a similar chart to what we've shown in previous quarters. This shows our loading for the historical months in the dark blue bars, and then moving into the loading in the current quarter, so that's April and May in the lighter blue bars, and then the forecasts on the right-hand side. So really the key takeaway from this chart is that our current order book and even our output result in May shows a significant uptick in revenue. I should stress that this is based on capacity loading, so revenue recognition may differ slightly from this, but overall this is showing a fairly positive picture as we go forward into Q1 that we will see an uptick in revenue. In terms of the outlook for subsequent quarters beyond this, they also continue to suggest kind of a further increase, you know, and generally a pickup in demand, but we would caution in that as we go further out, it's based more significantly on customer forecasts. So we will also have to see how how that plays out in the context of some of the wider uncertainties we have around the operating environment as well. But overall, it's a fairly benign to positive picture on the demand side. It does seem that there are increasing signs of that long-awaited recovery is on the way. And really, a final slide to kind of sum up kind of the key focus of the management going forward. So obviously, as well as focusing on ensuring that both divisions are sustainably and independently profitable, the real potential we see following the acquisition is about the synergies between the two divisions. So this slide is really an attempt to kind of capture that in some way. So what I'm showing here is on the left-hand side, some of the key strengths of the manufacturing division, and the same on the right-hand side for the brand licensing division. So on the manufacturing side, of course, it's our manufacturing capabilities, our knowledge of the textile supply chain, some of our strategic relationships with some of our larger US brand customers as well. While on the brand licensing division, it's really about the strength of their design capabilities, their understanding of our key markets, their relationships with some major European retailers, as well as their in-region logistics capabilities, and really their successful record of building really strong brands in that region as well. And so there's a lot to kind of build here through kind of additional demand coming out of the brand licensing division, and us on the manufacturing side, supporting the brand licensing division with the best manufacturing solutions, collaborating really closely on the best types of inventory solutions for their customers as well. And all of this is based on our kind of group-wide relationships across the fashion industry, which is a real way in which we can build connections and really build greater value. So you've already seen it, and I already mentioned it, in terms of connecting Tesco with a couple of our own brands and distributing those in Tesco stores. But there's a lot of additional opportunities to exploit there. So that's everything from, as I mentioned, our relationship with some major US brands, the diverse retailers that Focus Brands has strong relationships with, as well as our investor base and some of the brand owners with some of the licensed brands as well. So there's a lot we can be there, replacing Hela at the center of that fashion ecosystem across the value chain and really building greater value. So really that will be the key focus for the coming financial year, is how we make the most of the synergies between these two divisions. I think that'll be the key driver of growth going forward. So with that, I will draw the presentation to a close, and we can move on to the Q&A session. I can see that a few questions have already come in, so we will just, but please do also keep sending those in, and we'll run through as many as we can. So maybe I'll start with the first question, is that we have seen a significant increase in admin and distribution expenses, even after removing one-off expenses that were mentioned of about 500 million. Is this situation going to continue in the upcoming quarters? Rowan, maybe if I can ask you to take that one.
Yes, admin costs have gone up, but as Adam explained during the presentation, we are working on some initiatives, which is on top of the P180 project that we have delivered to reduce about $8 million of savings. So we are looking at further projects, further consolidations to see what costs that we can reduce, so that we can minimize the impact in terms of the exchange as well as the general overhead increase.
This includes the consolidation of Focus as well.
Correct. Correct. So yeah, there's about $14 million of $4 million of admin costs because of Focus for the quarter.
So just to add on to that, really the major driver of the increase, or the year-on-year or even quarter-on-quarter increase in admin and distribution costs, was really to do with the consolidation of Focus Brands, right? So as I mentioned, as well as kind of boosting up revenue, it did also increase the cost base. And so what you see there is with the addition of about 2 months of Focus Brands.
Yeah.
So it's likely that you will see a kind of increase in admin and distribution costs in the next quarter as well. But that is really us just working through the consolidation impact as well. Yeah. Sure. How does the appreciation of the rupee lead to an increase in costs? Can you explain it? Yeah, Rowan, I will let you tell them. So this is, just to be clear,
yeah.
this will be primarily for the private label manufacturing division.
Correct.
Yeah.
So I mean, we have about a $3 million of equivalent rupee overhead for operation. So that has an impact in terms of exchange. So of course we have hedged up to July. We will be looking at more opportunities in future, depending on the market movements. But in terms of overheads, we have about a $3 million equivalent overhead that is impacting the that has a exchange impact. We also have the same risk for Kenya, which is again we are watchful, and we have taken a decision to hedge Kenya as well.
So basically, since we are a dollar earning company, when the rupee appreciates, and we also have a certain element of rupee expenditure, so that is the impact that we are talking about basically. And 40% of our overhead base is in LKR. So since we earn in dollars, when rupee appreciates, it's necessary. I mean, our cost gets inflated.
Yeah. There is a question that is, despite the revenue increment, operational losses keep rising. Are there any plan to restrict this continuing loss? So I think the key point I'm going to highlight here, and what we were trying to show on the slides, is that this quarter was really impacted by a lot of one-offs. So even if you take out the gain on the acquisition, yes, then it looks like a large loss, but there were a number of one-offs on the other side, large negative one-offs as well, which is what on those two slides showing the adjusted EBITDA I was showing for the brand licensing division and the private label manufacturing division. That's really the underlying performance. So the brand licensing division on that basis was profitable. Yes, you're right. On the private label manufacturing division, there was a slight increase in the loss for the reasons which I outlined during the presentation. And that is certainly something that we're working on and ensuring that doesn't continue in the subsequent quarters. And that will also be kind of supported by the expected revenue increase as well. Maybe Delanco and Neville, I'll let you guys add on that.
That covers.
Yeah. So there's a question on what proportion of Hela's business is sourced by focus brands. So maybe Delanco, I'll ask you to elaborate a little bit more on what the kind of strategy is and kind of building that manufacturing relationship between the two entities and how that will impact the business going forward.
Right. So I think if you take this financial year as a percentage of Hela's business, focus would be roughly about 5% of its total sales portfolio. The growth is coming, over the subsequent months, because in our industry, you generally forward book 3 to 6 months ahead. So and also there is capability challenges, responsible exits from vendors in certain countries. So I think it'll take about a good 12 to 18 months. But that's set up 12 to 18 months to migrate all the programs that we want to migrate towards Hela. But then, like we said at the previous forum, Hela will have to continue to be competitive and give a better offering compared to the existing vendor portfolio of focus. So it's not that Hela is guaranteed it. It's whichever makes a better margin for the overall group will continue to be our focus.
Yeah. So there's a question on the licensing agreements of the brand licensing division. So are these licensing agreements mainly upfront costs or percentage-based systems? So for focus brands, it's not based on upfront costs. It is as a percentage of their revenue for that specific brand. There are license agreements that come with upfront costs, but the particular ones that focus brands has is based on a revenue percentage. So, yeah. What were the levels of capacity utilization of the private label manufacturing division during the quarter? So just to reiterate, that was mentioned briefly on one of the slides. Yeah. It was about 90%, or actually is a bit closer to 95%. So it is certainly increasing, and we are definitely now at that level where demand is more or less matching or sometimes exceeding our capacity as well.
I think what we will also have to mention to give some context is that the absolute capacity is increasing as well. So, and this is coming by working additional Saturdays, working a full work hour allotments. So even though there is a 94% capacity utilization in the last quarter, it's at a lower capacity overall. So what we're really doing from Q1 onwards, and you've seen it during the presentation in the months of April and May, especially in May. I think May was the highest standard hours we've achieved over the last 2 quarters, possibly 2 quarters or more. And June is even higher than that. So what we're doing is using the existing footprint, using the existing headcount as much as possible, increase your total work hours, and then subsequently your produce hours. Then at the same time, we are also using third-party capacity. So we are actually using third-party capacity right now across a couple of manufacturers in Sri Lanka, a couple of manufacturers in Kenya, and hopefully over the next 2 months, we'll be working with some third-party manufacturers across Egypt as well. So rather than increase our fixed cost base and our fixed capacity, we'll be going towards more variable scaling up options. And then once we get a better judgment of how sticky this demand, these new levels of demand we're seeing, we'll decide whether we want to internalize it or not.
Yeah, so there's a couple of questions on the demand picture, which I'll try and bring together. So both in terms of how are we seeing price growth versus volume growth, and also how are we seeing it differ between regions? So let's say US and Europe. So,
yeah, honestly, price growth sounds like a nice idea in our industry. So we haven't seen major price growth. I think what I can say is that we've seen prices from declining further. We did experience over the last 12 to 18 months continuous declining of prices. Given the market was having a lot of open capacity, a lot of the brands made advantage of that situation. But now with most players or most countries running close to full capacity, I think that era is over. We'll see some pricing stability. Whether we will see pricing upcharges, that's difficult to say, and I'm not too optimistic on that. What we are definitely seeing is we're seeing volume growth. As far as our budgets are concerned, we're looking at about a 20 to 30% growth year on year, and so far we're seeing the trends that show us that should be a achievable target.
Okay.
Yeah. So
you take that question. Okay, there's a question from Supesh, which is, Hela seems to be a highly geared company, but we can see current and future growth. How is the company planning to finance these initiatives? Can we see additional capital being raised in the future?
So that's one of the discussions we're having at board level. We are looking at strengthening the balance sheet through various exercises, and those will be notified over the next couple of weeks.
Okay. There's a question on whether we have any M&A plans for the next few years.
Right now, it's about consolidation. I think there's a lot of work for us to do on the focus side. And then more importantly, there's a lot more work for us to do to enhance or to unlock the synergies between focus and our private label manufacturing division. What we have done is we've rationalized some of the licenses that we carry at focus, and we've onboarded ones that we think makes a lot of sense. Like Adam mentioned, Reebok is a massive win for us, not only for focus, onboarding a globally recognized brand, but it also helps us onboard a product category which we think is very strategic for a country like Sri Lanka as we evolve out of this whole intimate space. But then also at the same time, it helps us to manage the seasonality a lot better because like Adam mentioned at the presentation, focus is a very spring, summer heavy business. This gives us a great chance at kind of leveling it in the future years by having a strong winter focused business as well. So I don't see any big M&A plans. We will continue to expand offering both on the manufacturing and on the licensing side and strengthen our balance sheet over the next few quarters and then explore any M&A opportunities subsequently.
Yeah, thank you, Jalika. Just to add on to that, there's a question of what type of digital transformation projects we're looking at or have done, and how that's supporting our factory cost optimization.
So right now, really, our single focus digital transformation is what we call our digital core. So we were running on multiple platforms, and just about 18 to 24 months ago, we went on one platform across the group, which was SAP S/4HANA. I wouldn't say we have still fully utilized or have executed in a way that we've unlocked total benefits from that implementation. So over the next 12 months, we will continue to keep working on this and then really try to restructure our business in a way that we can get the maximum benefit from these sort of digital investments.
Okay, thank you. So a question on focus brands as to whether the last quarter's gross profit margin would be the base to look at, or if there's any room for further improvements in margins at focus brands.
No, I think there's definitely space for margin GP improvement. What we've seen from best-in-class licensed players is they range between 30 to 40%. In sense, a good margin ranges from 30 to 40%. I know Focus is on the high 20s, and there's a very concrete plan given by the management to get us into that best-in-class levels over the next few quarters.
Okay, there is a. You want to take that one? So the question is, are there any female intimates brands in focus in the focus brands portfolio, and will this impact existing orders in the private label manufacturing division?
We don't have any dedicated female intimate brands or any underwear brands, but it doesn't mean that we won't look to onboard them in the future. We personally see it as an opportunity, because what we really want to do and what we're currently doing right now is speaking to the customers that we work on the manufacturing side, and then seeing how can we help them get into new markets or regions that they don't currently have a presence in. So for example, we're talking to our US focused American customers and helping them get into the UK European space. We're speaking to the UK guys to see how we can leverage our infrastructure in markets like Australia and take them into those markets. So I do think that the brands that we work with will see this as an opportunity and a value addition process than seeing us as a competitor.
Okay, there's a question on the manufacturing capacity split in the private label manufacturing division. Can we say what component is or has been in-house capacity and what has been third-party capacity, essentially outsourced capacity, and a comment on how the margins might differ as we go forward?
So right now, I mean, if you take the last month or this quarter, is give or take this quarter, roughly about 20% of our capacity is outsourced. We will probably see it range around that 20 to 30% mark. From a margin standpoint, it really depends. It's hard to say that in-house is more profitable than outsourcing. I think it's a less costlier way to scale up, especially if the growth you're experiencing is not going to be permanent. So like I said, it's a short to medium term strategy. Of course, we will have longer term partnerships with certain third-party manufacturers, but the more transactional ones will be a short to medium term solution.
Okay, there was another question on the operating margin of focus brands, essentially asking if the level of operating expenses recorded in the fourth quarter would be reflective going forward. I think it's a little bit tricky because the business is seasonal, and also we only consolidated 2 months. But we would say that the normal operating level of the business on its existing trajectory is an operating profit margin of about 3 to 5%. So that's kind of the base level, but we do see significant scope for improving that going forward as well. Yeah. So maybe we'll take a question on shipping issues. That's okay. This one. Okay. Can you shed some light about RM prices, industry trends, energy costs and current global trends.
Right. RM prices, I wouldn't say, I know here it says, I think it's currently reducing. I wouldn't say RM prices are reducing. It's probably come down from its peak. What we're seeing is that a lot of the supply chain partners, at least the tier one supply chain partners, they are running at full capacity. So I don't think we will see any continuous drops in RM prices. As far as energy costs are concerned, a lot of the countries that we are operating in have seen energy cost increases. And what's worsening the impact for us, again, like the team mentioned, is the appreciation of the currencies in the countries we operate in. You know, the world's best performing currency this year is the Kenyan shilling, and the second best performing currency is the Sri Lankan rupee. So that's 2 out of the 4 countries we have a presence in. So that is increasing our cost base. That is, to be completely honest, proving to be a challenge. And we have to kind of adopt our structures and our cost base and our top line as well to absorb some of these impacts that we're seeing right now.
Yeah, thank you, Dilanka. There's a question on inventory risk at the brand licensing division. So is there an inventory list on the company with the brand licensing model? And given weak demand, what would be the contingency plans in place for that?
Right now, there's very little inventory risks because the model we are following is on a made to order, or what we call a special markup sort of a business model. So we do have a back-to-back order when we are purchasing inventory. Will this always be the case? It's too early to say, because we also know that if we do take certain inventory risks, our margins are that much better. So it's a fine balance between back-to-back orders versus placing inventory and trying to sell through them.
There's a question on how borrowing costs are evolving. Maybe Navoja, you can take that one.
Yes, so the borrowing costs are averaging at about 11% right now for us. Weighted average cost of debt for us is about 11%.
Yeah. So I think we've covered most of these questions now, and we're just running a little bit short on time. So there's nothing else. I think, thank you so much for your time, and thank you for sending in all of your questions. Apologies, we haven't been able to get through absolutely every one of them, but if there is anything you would like to follow up on, please do contact us through the investor relations email address. So we'll be sending out the presentation after this call. As I mentioned, the recording will be available online. And please do let us know if there's any further questions or discussions you would like to take up. But that just leaves me to thank you all for taking the time to join the call today. We look forward to updating you once again next quarter. Thank you very much.
Thank you.
Have a good rest of your day.